over 50% of borrowers in June had less than a 20% deposit.
Kia ora, and welcome to a special guest edition of the New Zealand Property Market Podcast, brought to you by Cotality. I'm Nick Goodall, Head of Research for Cotality, and today I'm joined by two guests, Ryan Hannigan and Ben Grant from Loan Market in Dunedin. Fellas, thank you so much for joining me today. How are you both doing?
Yeah, doing good. Thanks, Nick.
Yeah, thanks for having us.
No worries. Surviving the nice chilly weather down there in the south?
Yeah, it's not too bad today. I think Dunedin was the warmest place in the country this morning, according to breakfast this morning. So we'll take that.
You've got to claim those things when they come up. Totally agree.
Yeah, 100%. Don't check in tomorrow though. Cold snap's on its way.
No, fair play. I studied down there, so yes, I know all about that cold snap when it comes through straight off the south. So fair play. Hey, well, awesome to have you both on, and I'm really looking forward to hearing what's going on down there in the south. I think it's been a really interesting market over the last wee while, really. But before we get all into that, I'm keen to hear a bit more about yourselves and your experience in the industry. So I don't know, maybe Ryan, you can kick us off. Tell us a bit about yourself, how long you've been in the mortgage advising world, and maybe a bit about what you do for fun on the weekends and keep yourself busy outside of work.
Yeah, 100%. So I Dunedin born and bred. Got out of high school, went to uni for a year, realised that I was spending far too much time at the Captain Cook Tavern and not enough for lectures.
Didn't we all?
And my best mate's mother said, "Oh, you should go and get a job in a bank." So walked in off the street, got a job as a teller, 18 years old, and the rest is history. That was my career from the word go. So did a good 10 years in banking and got to a bit of a crossroads and had sort of dabbled in all the different areas and decided that I really wanted to work with people in mortgages. And then the opportunity came up to jump ship to the other side and become an advisor, and made that leap, and that was 10 years ago, and haven't looked back really.
No, understandable. I mean, as I say to all our loan market guests, it's definitely well set up for that shift across and to set up a successful business. So good on you. And how about those weekends there, mate? What keeps you busy?
Yeah, I've got a wife and two teenage kids, so they certainly keep me busy running around after them. When I do manage to get some time to myself, I'm out on the golf course or training for half marathons. So yeah, couple of solitary exercises that I enjoy to get away from things.
Yeah, no, I hear you. Yeah, running is one of my pastimes too, and certainly when you've got children, good to get that time to yourself for a bit of thinking space, right? So yeah, fair play. Totally understand that. How about yourself, Ben? What about you in the industry?
Yeah, so like Ryan, Dunedin born and bred. So you've been here all my life, really. Great place to be. Haven't come from a traditional sort of banking background. Previously, I was selling cars, actually. So sold cars for about 5 years and did a bit of car finance as well. And then Sally Thompson was actually my mortgage advisor when I bought my first home. So yeah, always thought it'd be quite a good industry to get into. And then, about 5 years ago, there was the opportunity to come on board with Loan Market Dunedin and sort of started at the bottom as the client sort of services manager and learned the ropes, and then progressed up to a mortgage advisor. That's definitely been a journey, plenty to learn and still learning. Every day is different. Everybody's different, so it's exciting sort of industry.
That's the sort of thing that comes out with anything with customer and people interaction, right? That you don't get any 2 days the same, which definitely keeps it interesting. And interesting to hear that you sort of come about after dealing with a mortgage advisor, and I suppose that gives you an example of what good service looks like. And so you go, yeah, cool, can replicate that and get amongst it yourself. So interesting to hear that one. And what about yourself from a personal perspective, Ben?
Yeah, I've got a wife and a 1-year-old girl. It's just turned 1 a couple of days ago, actually. So as you know, they keep you very busy. She's crawling around all over the place now, not far away from walking. So yeah, definitely got our hands full with her. Like Ryan as well, play a bit of golf. Like him fit and healthy, a little bit of running and gymming and whatnot. So
yeah. No, I'm very thankful that I'm past that age of my children. They're sort of in between both of you, anyway, like 11, 9 and 6. So yeah, past the kids. and not quite at teenage level. So, I feel like I'm past that one happily, and not so much looking forward to the teenage phase, but I'm sure we'll figure it out once we get there.
Yeah, you got some fun times to come.
No doubt, no doubt. No, very good, mate. Well, good to get to know you guys a bit better. Let's get into understanding the local market then, and let's focus, I think, mostly on Dunedin. Though I know we can maybe stretch a little bit further than that as well. I don't know how to term this. Maybe it feels like there's generally a bit of a decent vibe down there. Values are holding up better than many parts of the country, even though there's pretty decent choice when it comes to what buyers can buy from what's listed on the market. I saw the median value is about 623K, so obviously pretty affordable compared to many parts of the country. What are you guys seeing in the market? How's that sort of going at the moment? What's your experience? How do those conversations go with you guys?
Yeah, I mean, as has been widely reported, the majority of the country's probably seen that growth stall and even dip in places. But we down here, down the south, like doing things a little bit differently. We like bucking those trends, and whilst it's still been reasonably flat, there's definitely areas of growth, and really positive signs as well. We're seeing sort of that first home buyer bracket is still really strong and really positive. There's a lot of inquiry there. And I think that's probably because we are still affordable for those people. You're looking at that first home buyer bracket being up to that 600 to 700K mark. If you're looking at things like the Kāinga Ora first home loan, well, the income caps means that they can still be right at that and still afford those sort of levels of loans. So it's definitely positive from our perspective there.
Yeah, I mean, for sure. First home buyer is such a great news story of the last, I don't know, couple of years, really. The strength of them and the way they're finding their way into the market. Obviously, people still need to be able to get jobs. So does that mean the sort of local economy is still doing pretty well too? I suppose partly supported by agriculture in the broader Otago region. Is that what you're finding? It's still attractive for, say, young families or young people starting off to get a job to move to Dunedin?
Yeah, definitely, and there's a lot of positive things happening around the area as well. We've got a reasonably large build happening in the centre of town at the moment that's well publicised. Hopefully,
Big hospital?
Yeah. So the first part of it is due to open next year. So there's been a lot of positivity and growth around that. But you're right, the other areas as well have certainly meant that we're seeing families from other regions move here because they can find work and also get on the property ladder. It's certainly more enticing to come down to Dunedin and have a purchase price of 600 as opposed to 900 or $1 million somewhere in the North Island.
What's the stock level like when you think about, when anyone thinks about Dunedin, they just think about the Dunedin flats, right? But that's probably underestimating the broader Dunedin appeal, and that there must be still some nice houses that have still got land. And so for quality of property and all those other boxes you can tick, right, that you can get some grass for the kids to run around in and things, is that stock all still pretty decent? And obviously getting out of the student area is pretty attractive for a family.
Yeah, definitely. I think we're pretty lucky here in the variety of stock we've got. Right from your first home buyers, your 1 and your 2 bedroom flats, there's still plenty of those floating around, particularly in areas like, your South Hannigan, your Caversham area, all the way through to your lifestyle properties out on the Taieri. There's something for everyone. But I keep coming back to that affordability piece. Your dollar can get you a lot more here than it can in other areas of the country, and that's really appealing.
Yeah, no, for sure. What about the investment side then? What about North Dunedin? How does that student market sort of play out? I know there's always going to be attractiveness of going and studying in Dunedin, for all the right reasons, of course. But what does that market look like? How active is that market? Are investors still coming and talking to you guys about getting a better yield? Which I know, according to our figures, the yield typically looks better on the surface in somewhere like Dunedin compared to in Auckland for sure. So yeah, what's that part of the market like? Are you seeing a retrenchment from those multi-property owners, or are they still finding those gems where they can actually get a bit of cash flow going?
Yeah, they definitely are. I think what we've probably seen in the last few years is less inquiry around those big student rental properties. The banks don't tend to like them too much once they start renting them out by room, as most student rental properties are. They start treating them like boarding houses, which gets quite difficult to lend against. But we're definitely still seeing the investors and their inquiries around the area. Your yields are still very good here. Rents are good, and prices are still relatively cheap. So it's definitely enticing. And I think we're seeing as well parents of students who are coming to town going, well, actually, we're going to buy something for our kid to move into and rent rather than paying someone else's mortgage. We can potentially help them get a foot on the ladder further down the track as well.
Interesting. Really good point. Can I just touch on that? The getting the mortgage for properties that are rented by bedroom though. So what's the bank or the financing justification for that? Why is it harder? Why is there more concern? Is it just because there's more turnover or something of those types of properties?
Yeah, it's something that we've probably argued with the banks for a very long time, because I mean it's a market that's not going away. The university will disappear overnight, but I think their policies are quite rigid behind the scenes, and once they start doing it by room, and you've got potentially 6 or 7 tenancy agreements for one property, they start going, well, this is a boarding house, and boarding houses are different rules to what a standard rental is. But it's a fight we fight every year, and one we don't seem to be winning. But hopefully one day they'll change their tune, and we'll be able to open up the lending for those type of properties again.
You do wonder if it's just yet hasn't sort of caught up with the times, right? Like, as you said, there's going to be a consistent level of demand there. There shouldn't be worries about vacancy or anything. So why not just look at it as, the package, even though, yes, okay, individually it's rented out slightly differently. Ultimately, it's still got a level of, rental income coming in, and the serviceability is still the same. So yeah, it's an interesting one. And as I say, maybe it's just one of those things that hasn't kept up with the times and needs to change. But yeah, who knows?
Yeah, and you think a lot of those properties, they're tenanted by now for next year. There's always a rush around the mid-year for the students to lock something in for the next year. So it's an area that we wish was a bit more open, and hopefully will be the way down the track.
Yeah. Well, yeah, it's even more certainty maybe than some other areas. But I suppose any shortish term accommodation, maybe that's also part of it. But anyway, we're not going to solve that today, but really interesting to know, because it's certainly something I'd not even considered or heard about previously. So great little insight there. Okay, I think, outside of maybe those first-time buyers, investors, what if we look at the sort of types of properties? You've touched on 1 and 2 bedroom, and then, of course, the larger student rentals. What about new development? Is there much new development happening, and maybe trying to attract the fact that there's going to be the hospital there, and there's the ability for more people to live in the area long term, so you need to continue to build properties? What's happening in that new development space?
Yeah, I think one of the things that Dunedin's had issues with for a long time is land that's able to be opened up for development, particularly in the city. If you've been to Dunedin, we're hemmed in by hills around the city. There's not much land left that can be opened up. Out on the Taieri, it's a different story, but they've got their own issues around infrastructure that they need to sort out before they can start opening up more land. One thing we've seen a bit of a growth in recently is more around like the developers coming in and buying an older property and knocking it over and putting in townhouses or units. Something that Christchurch has seen for probably 10 plus years. It's really starting to creep in here in Dunedin, and there's certain companies here in Dunedin. I think TGC is one of those.
Big ones, yeah.
Yeah, so they're coming in, they're doing that, they're buying up blocks of land, and they're whipping up townhouses and selling them off, and we're seeing that more and more. And that's a good thing. It's adding value to those areas that otherwise would be the lower end of the spectrum, but it's also utilising the land in a better way, putting more people in the homes. So we are seeing that more and more.
Exactly right. And I think, as you say, there's some similarities to Wellington where you're hemmed in by water and hills. And so, as you said, there's a restriction on the amount of genuine land that can be built on. So, yeah, we've got to do better with the limited amount we've got. And in general, across the country, we have seen that, as you said, Christchurch for a long time, Auckland since the unitary plan, knocking down those older properties. We need to modernise those properties as well. So, in that way, it's a good thing. I'm sure there's going to be some, old students that go, don't knock down those historic flats that they've lived in with, like, say, 8 to 10 bedrooms or something, and they've got reputation on Castle Street or whatever. So I'm sure we don't want to see those all turn into Townhouse Nation, but only for sentimental reasons, right? For the betterment of the country and the city, we do need to house more people in better quality property closer to amenities where people want to live, whether that's universities or CBDs or transport or whatever. So it all kind of makes sense, but yeah, maybe there's a little emotional side that says, oh, we can't lose the charm of North Dunedin, so we're going to have to deal with that at the same time.
I think it's a bit of a shift in mentality for Kiwis as well. I lived in London for 2 years, and you live in an apartment, you live with a shared common space out the back. Whereas Kiwis for so long have been, the dream was the quarter acre with the white picket fence. I think that the mentality is probably shifting away from that now. And the fact that you can have a nice, comfortable lifestyle in something that doesn't have a quarter acre. It's positive.
And has benefits with it too, right? Like less maintenance and less to be concerned about if you're a first home buyer.
Yeah, not mowing the lawns in winter.
I love mowing my lawn, but man, my grass is annoying me right now because it just doesn't want to grow as I want it to. So yeah, sometimes I wonder if it'd be better just to make it all concrete or something, which would, I'm sure not make many people pleased when you've got some land and then you go and ruin it. So we'll try and make it work. Hope for spring to bring something better. But anywho, enough about that. But look, I think that's really interesting in that Dunedin area. I'm keen to sort of chat about the lending environment shortly. But before we do and get to some questions for you too, Ben, just one last question for you, Ryan. That's just, do you extend a little bit beyond the Dunedin area out to the Otago region, maybe a bit further south as well? I mean, I know Invercargill certainly shows up on all of our, data when we see the strength of the market as Invercargill jumps out. Do you see much happening down in Invercargill or that broader Southland region as well that you can talk about?
Yeah, I'm pretty lucky in the fact that I look after Otago and Southland for Loan Market. So I try and get down there sort of once every 6 weeks or so. Southlanders are a different breed of people. They certainly play to their own song and tune, and they have definitely not seen the trends that the rest of the country has. They have completely bucked those trends, in fact. And I think the numbers show that they have had some of the strongest growth anywhere in the country for probably the last 3 or 4 years. Like Dunedin, affordability in Southland and Invercargill is fantastic. And we see it on a regular basis, like your first home buyers getting in for 300,000 to 400,000, and then your mum and dad coming to upsize once they've got a family. Well, they can sell that original 300,000 to 400,000 and get a 4-bedroom home with a decent bit of land in sort of Otago, just outside Invercargill, for 700. And I look at that and go, oh, do I want to move down there? Look, don't get me wrong, Invercargill was lovely, but I couldn't handle the wind off the photo straight all the time. So yeah, look, that I think that it's a really positive area of the country, is particularly into that growth. They're held up by really, really strong areas of employment as well. Predominantly, you've got your agriculture. There's, TY Point's down there, a really big employer. There's certain, the areas of employment down there are really, really strong, really good incomes, low house prices. If I was a young family, it'd be a great place to be starting out.
Yeah, no, I totally agree. And we've got lots of friends down there. My wife is from Invercargill, so we regularly visit. And a lot of her school friends and our uni friends have gone back down there and based them down there. And yeah, it's hard not to appreciate just how good they've got it, you know, when they say bringing up a family and how accessible the city is and, you know, easy to get around and all the attractiveness of that. So it does all make sense. And, you know, maybe like I said at the start, it's kind of, you know, a bit of ignorance is bliss. They, beat to the owner, move to the beat of their own drum, and yeah, just operate in a great environment down there. So it does all stack up. And as you said, it comes back to affordability, right? When you look at any of those affordability metrics, you know, you see that places like Invercargill, Southland, some of those smaller regions certainly look really attractive from that perspective. So it all makes sense. But no, really interesting to see what's going on down there. I'm really keen to chat about some of the conversations you guys have on a day-to-day basis with those borrowers, how they're navigating the lending environment. Of course, you know, it wasn't that long ago now we saw the 25 basis point lift to the official cash rate. And we know that there's the shifting preference in what people are doing from a refixing their mortgage perspective. So being really keen to hear how you're managing that conversation. What are people doing in Dunedin? What is their perspective on where things are heading? And how do you manage that conversation as to how do they structure their mortgages and what terms are they picking at the moment?
Yeah, as you say, you know, it's a very hot topic at the moment. Just off the back of that OCR announcement a couple of weeks ago, interest rates have started to bubble around and have increased in the past couple of weeks. So it's a very hot topic. But a lot of the time, you know, it's not what is the lowest rate that's the best for the customer. It's more so probably just trying to make sure that they are actually, you know, getting good advice and actually getting their loans, you know, structured correctly, whether that's sort of splitting loans, you know, using offsets and revolving credits and things like that as well. So not always just, you know, about the cheapest rate, because a lot of people will just, you know, ask what's the lowest rate, you know, can we fix in for that sort of term? But it's probably not the best sort of advice. A lot of the time at the moment, you know, we're seeing clients that are looking at sort of medium term, sort of within that, the 2 to 3 year space. Just for a little bit more security, you know, they can, put a budget in place and they know what their repayments are going to look like for the next couple of years. So yeah, you know, that 2 year rate, which is sort of sitting around that sort of 4.99 to sort of 5.19, I think at the moment, has been very popular.
Yeah, I mean, people put a price on certainty, and I suppose that's exactly it, is getting that certainty for a period of time. How much are people aware of the official cash rate decisions that are coming up? My personal view is that maybe it's drifting from the public consciousness these days, but it wasn't that long ago, maybe a couple of years ago, where it felt like, and I know I'm in the industry, so the conversations are always about this, but it felt like every man and his dog knew the Reserve Bank had a decision in 3 weeks' time and 2 days, you know, and they were really focused on that. Do you feel like that is still the case, or has that drifted away now and you're still, you know, you can educate more about what the official cash rate is, how it influences prices and things, rather than every single person seeming to know what's going on there and who the governor is and what they said 2 weeks ago?
Yeah, I think it has probably drifted away from, you know, everybody keeping such a close eye on it. Yes, they're aware of when the announcements are, but they're not, you know, watching it with a fine-tooth comb and that sort of thing. So yes, they're aware, but it's probably only a sort of real small sort of portion of clients that are really fixated on it. Your average sort of first home buyer is probably a little bit sort of unaware of sort of, you know, what's going on and when those sort of key dates are. And just, you know, going back to that sort of structure point, you know, it's not always about the rate. It's more so about, you know, the loan structure. So that's where I suppose, you know, the benefit of, you know, dealing with a mortgage advisor is so crucial, where you can actually sit down with a client, find out, you know, what their goals are, what their circumstances are, if they're planning a family in the next couple of years, or, you know, those sorts of things. So it's really just trying to get a bit more of an understanding of the client and sort of, you know, deciding on, you know, their loan structure following that.
Can be different for everyone, right? And I think the other thing I take from that is that it's also a good sign if people aren't just going, what's the lowest rate? Keep my mortgage payments the smallest because they're not struggling financially. And so is that real from your conversations too? Because, you know, I see that there's an article this week, I think, talking about how there's so few mortgagee sales out there. You know, we know that it's tough out there. There's cost of living crisis and the economy's not growing and, you know, all the global uncertainty as well. But it doesn't seem to be playing out with people really struggling. So, you know, is that true with your conversations? You're not getting people coming to you and saying, oh, we've lost a job, or, you know, our income's going to reduce, or we're not seeing any growth there. Can we change our payments? Can we reduce those down? Can we lengthen out the mortgage? Are you having any of those financial hardship conversations at the moment?
To be honest, not really, no, which is a good thing. Jobs are, you know, reasonably secure. So yeah, we're not having those conversations, which is great. You know, You definitely don't want to be having those sort of tough conversations with clients. A few years ago when rates were sort of moving around and payments were increasing by, $200 or $300 a week, that was a very tough sort of conversation. But yeah, touch wood, sort of not really having too many of those at the moment, which is great.
Yeah, I mean, it's great to hear people managing to make it work, which can only be seen as a good thing, which is awesome.
Yeah, I think just touching on that, I think it's that's that Kiwi mentality of I'll make it work.
Yeah.
It's I think it's just something we've probably always seen, and hopefully we continue to see as well.
Yeah, I think back to, when we got our first home, and part of the motivator was always, that old line of, pay your own mortgage, not someone else's, and, and all sorts of form of forced savings. Like there have been times over, the last few years, or the last long period probably, where you'd be like, actually, if you were really disciplined and you rented and you saved the difference between what your rent was and what your mortgage payments would have been, then you could have been just as well off, as long as that money was going into a strong investment, right? But you put it into a mortgage and it's the first thing that goes out. Whereas when it's rent, yes, the rent goes out, but then you spend all the rest of it, right? Because we're not disciplined enough to do something proactive with that investment. And I think that continues on. Once you've got that first home, there's just no question. Mortgage payment comes out on this day, money goes in, mortgage goes out, and that's the rest of our disposable income. And whether it's a good thing or a bad thing, I'm not really putting a judgment on that. It certainly leads us to want to own our first home because that is part of our nature. But yeah, like I said, it means that we prioritize it. It means that, generally we're seeing increasing equity over time because at the very least we're paying down our mortgage. Plus, there's likely some capital growth over the long term. And so you do increase your financial wealth longer term as well. So, it all makes sense, although we know we're in a sort of a changing environment these days with less expectation on capital growth. So we will see how that one goes. But the other thing on the first home buyer and having those conversations, Ben, as well, what's the situation for you guys in terms of deposit requirement? Everyone knows you need a 20% deposit, but the data tells us that not everyone actually does that or gets that and uses KiwiSaver too. So yeah, I don't know if you can put a proportion on it or how many conversations you're having about using KiwiSaver, and also what's the average level or what proportion of people are getting into the market with less than that 20% deposit?
It's definitely a big myth that, you can't buy a house with a 20% deposit. It's definitely not the case. There's options for clients, Kāinga Ora loans where you can get in with as little as 5% deposit, which is a great sort of stepping stone into the market. There's 10% options, 15, 20%. Yes, it is the magical number that, a lot of people are sort of striving towards. But it's definitely not the case. Plenty of options out there, which is great. I had a young girl who I got pre-approved and on the roof just this week actually, about 19 years old, and got pre-approved with a 5% deposit, about $20,000. So, that just shows you, there's plenty of options out there to get into the market.
That's impressive. So she wouldn't have had much KiwiSaver either.
No, not much at all really.
Wow.
But young girl, she's been working for a couple of years, and managed to get a pre-approved a couple of weeks. And she's out, looking for a property to purchase. She's already sort of got her eye on one, and hopefully she'll be able to get that under contract in a couple of weeks. So definitely options out there.
Love to hear it. And okay, so that's LVR restrictions. What about debt to income restrictions? I know they're mostly going to probably be a part of a conversation with investors. Does the DTIs come up for you at all? Do you have that conversation, or is it something for further down the track, do you think?
Yeah, we do have those conversations. It probably doesn't really come up too much in that sort of first home buyer space at the moment. And banks have got the discretion to actually lend over those sort of thresholds. So if you're buying your first home, your debt to income ratio typically needs to be under sort of 6. And if you're an investor, you're around that sort of seven times your income. But yeah, as I say, it's not to say that you can't buy a house if your DTI is above those thresholds. Banks are definitely able to go above, but you're not really seeing those sort of come into effect at the moment, which is good.
Probably a function of the market, right, where there's not much growth and people can get in without having to stretch those limits, which again, good, robust, responsible lending that's been happening for a while means things haven't gotten away on us. So I suppose it all makes sense. On that note, something that hasn't been talked about as much as it would have been, I don't know, maybe it was 2 or 3 years now, the old triple CFA, and also mortgage testing, like the interest rates that you test them at are a bit higher. How are they going at the moment? Do they even come into things? Everyone used to talk about how they would go through your statements on a fine-tooth comb. Have things relaxed there, or again, it's just because the market's more controlled that those conversations aren't relevant?
Thankfully, yeah, we've got out of that real tough niggly patch with the triple CFA roles where, they're going through what is expenses so closely, wondering what you had for breakfast this morning and things like that. So yeah, definitely gone away from that sort of approach now, which is great to see. Definitely makes, our jobs as advisors, a lot easier. Yeah, which is great really. On that as well, test rates. Yeah, test rates have been starting to sort of increase over the last couple of weeks, just off the back of obviously the OCR announcement, because that sort of flows onto the floating rates and the testing rates. So I think testing rates at the moment are sort of sitting around that 6.9% through to sort of 7.1%. So a couple of percent higher than what you can sort of fix in at the moment.
Yeah, I'm sure that might have been interest.co would sort of seem to check in on those and publish each of the banks' test rates themselves. I haven't actually seen them for a while, but yeah, good to know they're sort of in that band, and they do seem to just hover around that 2% higher than the actual rate say. So that again, that makes sense. Okay, and then the other, just before we move on from sort of what we call market environment, there's two other factors I think that I'll be keen to know whether it's something that comes up very often. That is, global geopolitics. So, how much people go, oh, what's going to happen in Iran and how much is that going to affect what we're doing? Or maybe it's back to your point earlier that people stick to their personal situation. And the other one, before we move on, is also the consciousness around the election. Of course, there's some pretty decent chat about different capital gains tax policy and other policies that might affect the housing market. Is that something you guys are talking about much, or you try and keep it about, look, worry about your personal situation, you can't control those things, so you move on?
Yeah, clients are definitely, more aware of what's going on, in the States, Trump, things like that, inflation, fuel prices, because, it's hard to get away from, it's in the media, news articles, social media, your friends and family are always talking about it. So it's sort of hard to not sort of think about it. And, that does potentially have a bit of an impact on, what customers intend to do. And, with that election, that's another one to sort of throw in the ring as well. So it's a pretty interesting sort of year, when you add in all those contributing sort of factors, and probably has, pushed people to sort of sit on their hands a little bit, and potentially, not want to make a big sort of financial decision at the moment in the sort of market that we're in and the sort of world sort of environment that we're in. Just on the election, I think potential sort of investors might be a little bit wary, whether there is a change in government that might bring in new legislation, the possible sort of interest deductibility. There's a few sort of factors there that could make a big impact if there is a potential sort of change of government. So yeah, it's a pretty rocky sort of environment that we're currently in at the moment.
Yeah, do you find that you might be talking to someone and they go, I'm interested, but I'm wary about this, so I might come talk to you in 6 months? Are people delaying their conversations?
Yeah, definitely.
Yeah, okay.
There's definitely been a few of those conversations, yeah.
Yeah. All right. Okay, all good. Well, I don't know if there's anything else on your mind, either of you, on that sort of lending environment and the day-to-day conversations you have. Otherwise, I'm keen to chat more about the mortgage lending industry, really. But yeah, anything else on your mind from a lending perspective that we're worth covering off?
I think just touching on that sort of first-time buyer sort of deposit space, I read an article a couple of days ago actually, and they said that over 50% of borrowers in June had less than a 20% deposit. So that just shows you, that low equity space of lending is so hot at the moment, and clients, sitting on the couch just thinking, shit, we actually need a 20% deposit. Definitely get in touch because it's definitely not the case.
It's a point we try and make every opportunity we do, whether it's talking to media or at presentations to consumers. And I always tell this anecdote. I remember talking to a mortgage advisor myself and saying, how's business been? And the anecdote was always, oh, yep, the OCR dropped, or they saw the Reserve Bank announce these restriction changes, so you can do more lending below the low deposit limits. And he said, so we get these people come into us and say, I saw the Reserve Bank It allowed more people, or there's no 20% deposit or whatever. And so the advisor would do the assessment of them and go, you were eligible prior to this change. Like, you should have just come and talked to us nice and early. But it's like they get triggered by something they hear. They go and talk to someone and that person goes, you shouldn't have worried about it in the first place. You were eligible 6 months ago. And so, yeah, we try and ram it home at every opportunity, because I talk to the likes of yourselves who say, yeah, as you said, the stats show it, your guys' experience shows it, that the majority of first home buyers get into the market with less than 20% deposit. And their motivations are there, right? They're exiting an expensive rental market. They are buying something long term. They're buying something for themselves. They might want to do some DIY, improve some value. Like, all of those things are strong motivators. If you want to do it and you're going to do it anyway, the best option is to go and talk to someone as soon as possible to find out where you're at and at what point you'll be eligible. Because for many people, they'll find out they're eligible before they even knew it. So yeah, we'll never stop talking about it. And I'm glad it's consistent with your guys' experience too.
Definitely.
All right.
And just on that as well, Nick, I think talking to an advisor is key, because you might be talking to your bank, but they may not have cap under their LVR restrictions at that time to lend in that over 80% space. So they might just say, look, no, sorry, we can't help. Well, you walk away going, oh, now's not the time. But that doesn't mean that the next bank down the road might not be able to help you, or the next bank, or there's an option under the Kāinga Ora first home loan. So I think the key is talking to someone like ourselves who has those options at our fingertips and can look at your situation and say, well, actually, yeah, you don't fit with Bank A, but Bank B is going to be your best fit here.
Yeah, absolutely. Yeah, I mean, I found when we did a renovation, the advisor knew exactly which banks were best at doing renovation loans, and the way they forward payments sooner and all that sort of stuff. So yeah, you can't beat that intimate knowledge of which banks are specialist at which things, right? And it changes over time. As you said, some might be really open to first home buyers 1 month, and the next month it changes again. And you guys are just so, granular on that information, because you're dealing with it day to day and putting those applications in, that where you get the fastest and best responses and who takes on more of different types of clients. So yeah, couldn't agree more on that one. All good. We might jump back to you there, Ryan, and carry on that conversation. I know, I don't want to lean on your experience or age here too much, but you've obviously been doing mortgage lending for a while. How do you sort of reflect now, after a few years, on what is the most important thing to you, for you, when you're dealing with clients and to talking about what, how to get them that loan, really, how to help them to get that property, whether it's a first home buyer or someone moving house or someone buying an investment property?
Yeah, great question. I think when it comes to a first home buyer, the best thing that they can do is be prepared and get pre-approved, because it's going to save a lot of time and a lot of stress down the track when that property that they find comes up. We still see it on a regular basis. You get the phone call on a Monday morning saying, hey, we found our dream home, what do we do? Well, we need to get you approved for a start. But, if we can get them in and have those conversations early on and map out a plan of how we're going to get them into their home, it's going to save a lot of that stress down the track and rushing around as well. I think we talk a lot about getting clients approved, or what we call real estate pre-approved. And the difference being that if you're if you're pre-approved with your bank, they've given you a pre-approval, you have to do all these things on your approval before you can get the money. But we want to get those clients to that real estate pre-approved position where they can go and make an offer on a house with as little conditions on that offer as possible. So that if they are in a multi-offer situation, theirs is at the top of the pile. It's not, okay, it might be 20 grand more, but they've got to do all these other things here, so we're going to go for this one over here that's got less conditions. So I think getting in front of them early, having those proper conversations about what they need to do, and getting them in the right place to be making an offer on their home when it comes up is key.
Yeah, okay. On the pre-approval side of things, how open are the banks to those at the moment? Because I know that, through time, they've sort of got their red and green lights. Sometimes they'll pre-approve current customers, but they won't for non-bank customers that are with them at the time. What's the current situation across each of the different banks, in terms of their willingness to have most or more pre-approvals out there? Is it okay because those LVR restrictions aren't being tested, or where are they at the moment?
Yeah, they change on a weekly basis. We get the emails once a week from the banks with updates on their traffic lights. Generally, what you're looking at is for an over 80% deal, so a low equity loan, you can get a pre-approval with your existing bank. There's no real issues, I don't believe, at the moment in regards to that. The other ones kind of open and shut their doors a wee bit, depending on how much cap they've got under that limit. So again, that it's another reason to be talking to an advisor, because whilst we might be able to get a pre-approval with your bank, there might be an option over here as well.
Most of the banks are all pretty open to that sort of over 80% sort of space. And even more so, if it's a live deal, just because, you don't have your banking with that bank, if it is a live deal, you can basically go anywhere, because banks, it's a live contract. They know it's probably going to go through and settle, so they're definitely keen to do their business.
Yeah, okay. I mean, we see how competitive they are, and especially in that first home buyer space. So again, they have to play the game, or else they're going to fall behind, right? And we know the pretty strict targets those guys are on to continue to expand their book. So yeah, totally get that. Maybe this will be one of the things you can talk about, Ben, but I want to talk about some of the greatest challenges that advisors are facing today. It wasn't that long ago where it was turnaround times at the banks. I don't hear that quite as much, and it's probably a sign of the market being quieter. But yeah, what's the sort of biggest challenge for you guys as advisors now operating in this environment, this market, for you?
Yeah, I think on one hand, it's potentially the rise of AI. It's great on one hand, but potentially not so great on the other hand, because information is so readily available to clients. They can go on ChatGPT or Claude or whatever those apps are that they choose, and basically type in a question, and then everybody thinks they're an expert. You only have to look on sort of Facebook, first home buyer groups and investor groups, and everybody's commenting and trying to answer questions and thinking they're experts. But a lot of the time that information is not correct. You read through some of them and you just sort of shake your head. So yeah, that's probably one sort of challenge that the industry's sort of facing at the moment. And the other one is possibly that sort of bank versus broker, who services the client first. Banks are pretty proactive in trying to get in front of those clients for refixes and things like that. We see one of the main banks at the moment offering a sharp sort of 6-month rate special, for clients to refix online. But that 6-month rate is potentially not, the best sort of term or, best option for that client. We listen to yourselves and, Tony Alexander and those sorts of economists who are sort of, advising in that sort of 2 or 3 year space. So, if a client jumps online and then selects a 6-month rate because it's the lowest rate, and suddenly in 6 months' time rates are higher, it's not the best option for that client. So it's probably just trying to have those good, honest, conversations with the client nice and early. As you say, finding out what their plans are and just getting that, that structure correct for them.
So is there anything in particular you think you could do or you're already doing to try and counter that challenge of the AI advice? Like, are you guys finding ways to try and get ahead of that, or it's just something you're trying to figure out as you go, as people come in with certain levels of education that you have to shift in one way?
Yeah, it's a little bit of both, really. You do have to obviously embrace that sort of AI. It's definitely a bubble, and if you don't jump on board and embrace it and implement systems into your business, then you are just going to get left behind. So it's definitely something that we're sort of looking at, continuing to introduce in our businesses. So yeah, but yeah, as I say, it is a little bit dangerous on the other hand.
Yeah, I think the one area that I'm trying to learn more and more about is, the old used to be search engine optimization. That's how you can make sure that when someone Googles that your website comes up and your information, it's answer engine optimization, and it's making sure that those tools are picking up your information that's out there, so that that's feeding the good stuff, right? And it's using Cotality in my case more often than it is going to use any other external sources for, what property data is out there or what information is best. So yeah, maybe that's the one, is to educate ourselves and how we help those tools to be using the right information so that we know it's being served up to those customers when they're asking those types of questions. And some of the stuff I've seen from like our marketing team as to how they're looking at, what people are asking, you can get that data from behind those answer engines and then make sure that your information that's out there on the website is actually tailored for that too. So it's being picked up by them and it's referencing as a source so that you can have a bit more confidence in it. So maybe that's part of the question, but I'm certainly not an expert in that area. Just something that I've recently been stumbling across, which I find really interesting. So yeah, it's a good one. All right. Okay then. Well, I suppose on that, how we're dealing with that, and I don't know if you've got maybe one core tip, because I know obviously the business down there is very successful and dealt with Brian Greer for many a year. Is there any sort of tips you've got to being successful as mortgage advisors for those others that are in the industry alongside you guys? One tip each for being successful in your industry.
Yeah, I think for existing advisors, it's probably just making sure that you do a great job with your existing set of clients. If you look after them well and you do a great job for them, they are going to be your best referrer. They'll tell their friends and families that, Ben and Ryan did great jobs for us, go and see them. We see, clients referring their siblings, kids, grandkids in some cases. So, yeah, I think that's, such an important part of the market is, doing a great job for your existing clients. Because, in our business at Loan Market Dunedin, I'd say probably 80% of our referrals come from our existing client base.
Yeah, great call. It reminds me of the conversation I had with the loan market advisor in the Wairarapa, and he had a story where he was providing mortgages to a third generation of families that he's dealt with, and I was like, yeah, you can't beat that. So that speaks right to that, and obviously there's consistency across your guys' business through the country. What about you, Ryan?
I think just quickly on that as well, in regards to your existing client base, like in our industry, it's all well and good when it's busy. We're balls to the wall and struggling to keep up when it's good times, but when it's quieter, I think it's about being proactive and picking up the phone and calling those existing clients and being front of mind for them when they've got a life event come up. Whether it's we've got a baby and we need to upsize or do some renovations or buy a car. You want to be front of mind. You want them to go, actually, I'm going to pick up the phone. I'm going to call Ben and I'm going to see if they can help. So I think that's one thing we can do as well. I think for someone starting out in the industry, the best thing you can do is link yourself up with a good external referral source, whether that be a solicitor, an accountant, but I think the best ones are a real estate agent. They're on the coalface. They're seeing the buyers firsthand, week in, week out. If you can get married up to one of them who is asking the right questions and pointing those clients in the right direction, then that is fantastic. And what you'll find is that it brings that trust as well between the different parties. So if you can get one that comes through and you do a good job and you get a buyer across the line for that real estate agent, I can guarantee you more will follow. So yeah, that would be my advice. Get out there, find a good real estate agent that you can buddy up with.
Yeah, win with good partnerships, right? And I know obviously the loan market business is tight with the Ray White side, so I'm sure you guys have got plenty in that space. The other one, so you want to stay front of mind. So does that mean there's like, the dynamic duo, Ryan and Ben, billboards all around Dunedin?
Oh, there's a couple of billboards around. Oh, not billboards, but property billboards.
His mic on the billboard, not mine.
You put the young fella up. That's it. Oh, I love it. No, brilliant. Well, I mean, that's pretty much going to do us for today. I suppose one of the last things to chat about is just, what's the best way for people to get in touch if they do want to talk about the options down there and then come in to speak to you guys about getting that personalised advice.
Yeah, just jump on our website, Loan Market Dunedin. All our contact details are on there. So yeah, pretty easy to reach. Yeah, reach out, get on the phone, flick us an email, and yeah, we're happy to help out.
Any strong social media game? You got a TikTok account, Ben?
No TikTok for me. I'm pretty average on that social media front. So yeah, definitely work on.
It's like every conference I go to or whatever, there's always a social media expert telling everyone, whether they're brokers or real estate agents, how they have to have that social media presence. But I guess it just doesn't fit some people's personalities, right? It's pretty hard to force yourself into that basket if you're not really natural in that space. So you kind of got to have a presence, but maybe it's going to be, not quite as strong or as unique as some of them out there, because there's some pretty interesting ones out there who are almost like, directors of little mini films. It's amazing.
Yeah, definitely. We've got a Facebook presence, Loan Market Dunedin, but that's about it.
Yeah, you're like classic Otago, spates and play a bit of golf, eh? I love
Yeah,
it. I love
100%.
it. No, that's great, mate. Oh, well, hey, listen, thank you both so much for coming on the podcast. I suppose just one last chance, if there's any final words or thoughts that you wanted to get out there before I wrap up and let us get on with the rest of our days. What have we missed?
No, I think we've covered just about all of it, to be fair. Look, as we sort of mentioned, it has been a little bit flat, it has been a little bit quiet, but I think one thing this industry has taught me over 20 years is that you've got to ride these quiet periods out. That the good times are just around the corner again. So let's hope that we can get through the rest of 26 and move on.
Yeah, well, let me really put you on the spot then, Ben. What's the future got? What are we going to see? When does the growth come back? Or I suppose if there's been some growth down there, it's not so bad.
Yeah, it's a tricky one. It's a tricky one, Nick. Yeah, I think seeing much growth is probably still a couple of years away. I think it's going to be pretty flat by all reports. So it's just a matter of just riding out this wave, bring on summer. Hopefully, they'll bring a bit of warmer weather, give people a little bit more confidence, get the selection out of the way, and keep getting people into these properties.
Yeah, no, bang on. And fingers crossed we get this Strait of Hormuz back open again. A strait that I don't think many people knew about 6 months ago, and now we're all experts on. But let's get that reopened and get back to some global normality. And I'm sure some some better economic growth times will come, and with that follows obviously the housing market. So yeah, let's have the fingers crossed for that one. All right, gents. Well, that will do us for today. So thanks again for coming on. Always good to get into some of the nitty gritty, and certainly in markets that we don't probably spend as much time as we do in some of the other larger centres like Christchurch, Wellington and Auckland. So yeah, really want to appreciate getting that insight. So just leaves me to say thanks very much for listening. Please do get in touch with any questions or feedback or thoughts for our future podcast guests as well. Always keen to hear who out there we might be able to talk to and hear about what's going on in those local markets. So please do get in touch with that. My details are all within the show notes of the podcast player listening through right now. But that's all for today. Just wanted to say thanks once again. My name is Nick. They're Ryan and Ben from Loan Market Dunedin. You've been listening to the New Zealand Property Market Podcast. Mā te wā.